We've covered many different valuation models that are used to work out the intrinsic value of a stock on this channel recently, and in today's video we're going to cover another one, and that is Gordon's growth model. It is also commonly known as the dividend discount model. This method of valuing a stock has been around for a long time. It was first published in 1956 by Myron J. Gordon. The whole premise of Gordon's growth model is that the share price of a company should be equal to the net present value of all its future dividend payments. It's quite a popular valuation model to use, I think primarily because of its simplicity. Your formula here, there's not many inputs that you need to actually do your own calculation on the intrinsic value based on the Gordon growth model. Even though on the face of it, it does look very easy to calculate, there is a little bit of work involved in coming to your inputs here that will need to go into this formula, and I'm going to go through them here now very shortly. And just so you know, this Google Sheets calculator is free to download. There is going to be a link down in the description section and also in the comment section if you want to access your own editable version of this calculator. Just follow these instructions here up on the top right hand side to make your own copy, which you can then use for yourself. Okay, so now let's go through the calculator briefly, as well as all of the workings that you're going to need to do to come up with your intrinsic value here for the company that you want to look at. So the very first step you should do when you're working with this calculator is you should put in the ticker symbol of the company that you plan to look at. For this example, we are going to be looking at Coca-Cola, so I've put in the ticker symbol KO here. Now the top line of Gordon's growth formula is D1. So D1 is actually your expected dividend in 1 year's time. So you can work that out by taking the current dividend of the company, Coca-Cola in this instance, and multiplying it by the expected growth rate over the next year. A very useful website to find this kind of information is Dividend.com. So I've just come onto the Coca-Cola company's page here on Dividend.com, and I can see straight away the expected dividend for 2023 if you hold one share of Coca-Cola is $1.84, and that is what I have used for the basis of my calculation of D1. But this $1.84 is really the D0 value, and I need to work out D1, so I need to multiply this by the expected growth rate over the next year. And you can find this kind of data also on Dividend.com here if you just go to the dividend growth section here. So the expected dividend growth over the next year is 4.55%. So that is what I have used to work out my D1 value. I've taken the $1.84 and multiplied it by 1.0455% to come up with $1.92 as my D1 value. Now Dividend.com quote a lot of different expected growth rates. They have growth rates over the next year, the annualized growth rate over the next 3 years, 5 years, 10 years and 20 years. For your calculation, you are also going to have to select a growth rate which you think the dividend of the company is going to continuously grow into the future. So this is where you need to use a bit of judgment. I could have went with 7.42% is what they expected the average growth rate to be over the next 20 years. Or I could have went with a lower estimate here of 3.36%. But I decided to stick with the same growth rate that I just applied to the D1 calculation of 4.55%, and then I have input that here into one of my inputs here, the G. So that is your constant growth rate in perpetuity expected for the dividends of the company. So that's two of the inputs in this formula that we have already worked out. We worked out our D1, and down below the line here we have worked out our G, which is our growth rate in perpetuity for our dividends. But we still have to work out this R, and what this R is the cost of equity of the company. And there is a little bit more work involved in calculating this. To work out the cost of equity of the company, we can use the capital asset pricing model, which is CAPM for short. So similarly, again here, I have added in all of the different inputs that you're going to need to work out your cost of equity. So you just need to put in your ticker here. So I've put in KO again. Then you're going to have to add in the risk-free rate of return on the market at the moment. So what I've kind of used as a proxy for that is the yield on 3-month treasury bonds. The current rate on 3-month US Treasury bills is 5.27%. That has changed slightly since I last updated my calculator here, so I'll just update to 5.27. So then I'm going to need the beta of my stock, and that is going to calculate automatically from this Google Finance formula once you have input your ticker of the stock that you're looking at. Now you can also go with the unlevered beta, and that will need a little bit of work to actually remove the debt element that's included in this beta calculation for your stock. And then lastly, you're going to have to work out what the expected market return is. And what I've used as the proxy for the expected market return is I've taken the average return on the S&P 500 over the past 30 years, and that is coming in at 9.14%. You can use any other index or any other method that you feel is appropriate here. So once I have all of those inputs added here, it will work out my cost of equity, which it is saying is for Coca-Cola right now 7.36%. And that is then going to feed in here as my R value for our Gordon growth model calculation. So I have all of my inputs now sorted, and it works out the intrinsic value of Coca-Cola at the moment at $68.41, which is actually 13.5% higher than the current market share price of Coca-Cola at $60.26. Now, before you run off and saying, oh my god, Coca-Cola is undervalued, I'm going to go off and buy it now and hopefully bank at least 13.5% gain over the next couple of months, you need to be aware of a couple of weaknesses with this valuation model. The result of this calculation is highly sensitive to any changes in these inputs, especially if you're changing the growth rate or the cost of equity. Let's say, for example, here I change my growth rate from 4.55% to 5%. All of a sudden, it is giving Coca-Cola an intrinsic value of $81.80 per share and showing that the company is currently 36% undervalued. So that's quite a large change just from a small little change in the growth rate. So two people who do this same calculation can end up with completely different answers. For that reason, it is probably wise to add in a large buffer here. For example, you only pay heed to this calculation once it is 30% or more undervalued. That way, at least you protect yourself from being overly optimistic with your assumptions. Another weakness of this valuation model is that it expects dividends to grow at a constant growth rate into perpetuity, so forever at the exact same growth rate. But in reality, companies, either due to, say, trading or economic conditions, may decide to pause any dividend increases over a period of time, or even stop paying dividends at all. Maybe they have a big investment to make and their cash is better used being put towards that. If the company you are looking at hasn't had a steady long-term growth in its dividends over the past, say, 10 or 20 years, then maybe this is not a valuation model that is suitable for this company whatsoever. Again, Dividend.com is a good place to go and check this. So as we can see here, Coca-Cola has 62 years of dividend increases. So they are really committed to constantly increasing their returns to their shareholders in the forms of dividends. So based on that, I would be happy to use Gordon's growth model for Coca-Cola, but there's plenty of other companies that I wouldn't use it for. So that's just one thing to check out before you use the valuation model. Aside from that, there is many other weaknesses that I won't go through on this video, but I'm sure you can find them online. And that's pretty much all I have for today, folks. Thanks very much for watching, and don't forget you can download your own copy of that calculator that I went through there in the video down in the description section if you want it. I hope you found it useful. If you did as well, please make sure and drop a like on the video, and I would really appreciate it if you could subscribe to the channel as well.